Question 1. Quality control measures reveal that a municipal advisor, acting as a financial feasibility consultant for the city of Springfield, Illinois, has prepared a report for the city's pension fund. The report projects a strong positive financial outlook for the pension fund based on optimistic market performance assumptions. However, the advisor has not independently verified these assumptions against current market conditions or explicitly detailed the potential risks associated with these optimistic projections to the city. Which of the following approaches best reflects the municipal advisor's regulatory obligations and professional responsibilities to the pension fund? Option A. Advise the city to proceed with the plan based on the optimistic assumptions without independently verifying them and without explicitly communicating the speculative nature of these assumptions to the pension fund. Option B. Present a financial feasibility report that emphasizes the most favorable outcomes, downplaying or omitting any potential negative scenarios to maintain a positive perception of the pension fund's financial health. Option C. Conduct an independent analysis of the pension fund's financial feasibility, clearly identifying and disclosing all potential risks and uncertainties to the city, even if they temper the optimistic outlook. Option D. Focus exclusively on the immediate financial benefits to the city of Springfield, disregarding the long-term financial implications for the pension fund's beneficiaries. The correct answer is C. Conduct an independent analysis of the pension fund's financial feasibility, clearly identifying and disclosing all potential risks and uncertainties to the city, even if they temper the optimistic outlook. Explanation: scenario analysis. This scenario presents a common challenge for municipal advisors dealing with pension funds. The core difficulty lies in balancing the fiduciary duty owed to the pension fund's beneficiaries with the need to secure a favorable outcome for the municipality, especially when financial feasibility is uncertain. The advisor must navigate potential conflicts of interest and ensure that advice provided is objective, independent, and solely in the best interest of the pension fund, as mandated by MSRB Rule G44 and related guidance. The pressure to present a positive financial outlook can be significant, but regulatory compliance and ethical obligations take precedence. Correct approach analysis. The best professional practice involves a thorough and independent assessment of the pension fund's financial feasibility, explicitly identifying and disclosing any potential risks or uncertainties to the municipal entity. This approach prioritizes the fiduciary duty to the pension fund by ensuring that all advice is grounded in objective analysis and that the municipality is fully informed of the potential implications of its decision. This aligns with the MSRB emphasis on municipal advisors acting with diligence and care and avoiding misleading statements or omissions, as outlined in MSRB Rule G44. By clearly articulating the financial realities, including potential downsides, the advisor upholds their responsibility to provide advice that is suitable and in the best interest of the pension fund. Correct approach is analysis. Presenting a financial feasibility report that highlights only the most optimistic scenarios, while downplaying or omitting potential negative outcomes, is a significant regulatory and ethical failure. This approach violates the duty of care and diligence owed to the pension fund by providing incomplete and potentially misleading information. It creates an environment where decisions are made based on an incomplete picture, potentially jeopardizing the long-term financial health of the pension fund and its beneficiaries. This directly contravenes the principles of fair dealing and acting in the best interest of the client. Advising the municipality to proceed with a plan based on assumptions that are not rigorously supported by independent market analysis, and without clearly communicating the speculative nature of these assumptions to the pension fund, is also professionally unacceptable. This demonstrates a lack of due diligence and a failure to act in the best interest of the pension fund. The advisor is essentially endorsing a plan without a solid foundation, potentially exposing the pension fund to undue risk. This breaches the obligation to provide advice that is suitable and well-researched, focusing solely on the short-term benefits to the municipality, without adequately considering the long-term financial implications for the pension fund's beneficiaries, represents a failure to uphold fiduciary responsibilities. While municipal advisors serve the municipality, their advice regarding pension funds must prioritize the financial well-being of the fund's beneficiaries. Ignoring potential long-term negative impacts, such as increased unfunded liabilities or reduced benefits, is a direct violation of this duty. Professional reasoning. Professionals should approach such situations by first establishing a clear understanding of their fiduciary duties to the pension fund. This involves conducting independent and comprehensive financial feasibility studies that consider all relevant market conditions and potential risks. All findings, including uncertainties and potential negative outcomes, must be clearly and transparently communicated to the municipal entity. The decision-making process should be guided by a commitment to providing advice that is objective, unbiased, and demonstrably in the best long-term interest of the pension fund's beneficiaries, adhering strictly to MSRB regulations and ethical standards. Question 2. Governance review demonstrates that a municipal advisor, City Finance Partners, is advising the City of Springfield, Illinois, on a potential bond issuance. A senior partner at City Finance Partners also sits on the board of a local bank that is a frequent underwriter of municipal debt for other municipalities. Which of the following actions best upholds the municipal advisor's regulatory and ethical obligations to the City of Springfield? Option A. City Finance Partners suggests the City of Springfield engage a separate, independent advisor to review their advice due to the potential conflict, without fully disclosing the nature of the conflict themselves. Option B. City Finance Partners provides the City of Springfield with full written disclosure of the partner's board position, detailing the relationship and outlining steps to mitigate any potential conflicts of interest. Option C. City Finance Partners decides not to disclose the partner's board position, believing it does not directly impact the current advisory services for the City of Springfield. Option D. City Finance Partners verbally informs the City of Springfield's finance director about the partner's board position without any written documentation. The correct answer is B. City Finance Partners provides the City of Springfield with full written disclosure of the partner's board position, detailing the relationship and outlining steps to mitigate any potential conflicts of interest. Explanation. Governance review demonstrates a municipal advisor, City Finance Partners, has been providing advice to the City of Springfield, Illinois, regarding the issuance of municipal securities. The review highlights a potential conflict of interest involving a senior partner at City Finance Partners, who also serves on the board of a local bank that frequently underwrites municipal debt for other municipalities. This scenario is professionally challenging because it requires navigating the delicate balance between providing objective, client-focused advice and managing potential personal or firm-level financial entanglements that could compromise that objectivity. The Municipal Securities Rulemaking Board, MSRB, Rule G42, on fair dealing with municipalities and other obligors, is paramount here, requiring municipal advisors to act with professional diligence and to avoid conflicts of interest. The best professional approach involves City Finance Partners proactively disclosing the relationship with the local bank to the City of Springfield in writing. This disclosure must clearly outline the nature of the relationship, the potential for conflicts, and the steps the firm will take to mitigate any adverse impact on the city. This approach aligns with MSRB Rule G42's emphasis on fair dealing and the fiduciary duty owed to the municipal client. By providing full transparency, the firm empowers the city to make an informed decision about the engagement and to assess the potential risks associated with the conflict. This proactive disclosure is a cornerstone of ethical municipal advisory practice, ensuring that the client's interests remain paramount. An approach where City Finance Partners decides not to disclose the board position, believing it does not directly impact the current advisory services, is ethically and regulatorily deficient. This failure to disclose a potential conflict of interest violates the spirit and letter of MSRB Rule G42, which mandates fair dealing and the avoidance of conflicts. Such an omission erodes trust and deprives the client of crucial information necessary for informed decision-making, potentially leading to advice that is not solely in the city's best interest. Another unacceptable approach would be to disclose the relationship verbally to the city's finance director without any written documentation. While a verbal disclosure might seem like an attempt at transparency, it lacks the formality and permanence required by regulatory standards and ethical best practices. Written disclosure provides a clear record, ensures all relevant parties within the city are aware, and serves as a reference point for future discussions, thereby failing to meet the robust disclosure requirements of MSRB rules. Finally, an approach where City Finance Partners suggests the city engage a separate advisor solely to vet their advice due to the conflict. without fully disclosing the nature and extent of the conflict themselves, is also problematic. While seeking independent review can be a mitigation strategy, it should be a supplement to, not a substitute for, the municipal advisor's own obligation to disclose and manage conflicts transparently. This approach outsources the primary responsibility for conflict management and disclosure, which is a core duty of the municipal advisor. Professionals should employ a decision-making process that prioritizes transparency and client interests. This involves a thorough internal review of all relationships and potential conflicts, followed by prompt, clear, and comprehensive written disclosure to the client. If a conflict cannot be fully mitigated, the professional must assess whether continuing the engagement is in the client's best interest and be prepared to withdraw if necessary. Adherence to MSRB rules, particularly those concerning fair dealing and conflicts of interest, should guide every step. Question 3. The control framework reveals that a municipal advisor in California is reviewing its record retention policies for electronic communications. Given the requirements of SEC Rule 17(a)(4) under the Securities Exchange Act of 1934, which of the following approaches best ensures compliance with the preservation of records for municipal advisory activities? Option A. Retaining only formal written correspondence and disregarding electronic communications such as instant messages and internal chat logs. Option B. Implementing an automated system that captures and stores all electronic communications, including emails and instant messages, in a non-erasable, non-rewritable format for the required retention period, ensuring the first 2 years are readily accessible. Option C. Storing all electronic communications on individual employee hard drives or personal cloud storage accounts for a period of 3 years. Option D. Relying on individual employees to manually identify and archive communications deemed significant to municipal advisory activities. The correct answer is B. Implementing an automated system that captures and stores all electronic communications, including emails and instant messages, in a non-erasable, non-rewritable format for the required retention period, ensuring the first 2 years are readily accessible. Explanation. The control framework reveals a critical juncture in managing regulatory compliance for a municipal advisor in California. The scenario presents a challenge because it requires a nuanced understanding of SEC Rule 17(a)(4), which dictates record retention requirements for broker-dealers and municipal securities dealers, and how these apply to municipal advisors under the Securities Exchange Act of 1934. The professional challenge lies in ensuring that all communications, regardless of their perceived importance or format, are captured and preserved in a manner that meets regulatory standards, thereby safeguarding the firm from potential enforcement actions and maintaining client trust. The firm must balance operational efficiency with stringent compliance obligations. The correct approach involves establishing a comprehensive system that automatically captures and retains all electronic communications, including emails and instant messages, related to municipal advisory activities. This system must be configured to store these records in a non-erasable, non-rewritable format for the duration mandated by Rule 17(a)(4), which is typically 6 years, with the first 2 years readily accessible. This method directly addresses the core requirements of Rule 17(a)(4) by ensuring that all relevant records are preserved and accessible, thereby demonstrating a proactive and robust compliance posture. It aligns with the regulatory intent to have a complete audit trail of communications that could impact investment decisions or advice. An incorrect approach would be to rely on a manual process for identifying and archiving communications, with the assumption that only certain types of messages are significant enough to retain. This fails to meet the broad scope of Rule 17(a)(4), which does not differentiate based on the perceived importance of a communication, but rather on its relation to the business. Such a manual system is prone to human error, omissions, and subjective interpretation, increasing the risk of noncompliance. Another incorrect approach is to store all electronic communications on individual employee hard drives or personal cloud storage accounts. This method creates significant accessibility and security issues. Rule 17(a)(4) requires that records be readily accessible to regulators. Storing records in decentralized, non-controlled locations makes it nearly impossible to produce them promptly and comprehensively when requested, and it also exposes sensitive client information to greater risk of loss or unauthorized access. Finally, An incorrect approach would be to retain only written correspondence, such as formal letters, and disregard electronic communications like instant messages or internal chat logs. Rule 17A4 explicitly includes electronic communications within its purview. The intent is to capture the full spectrum of business-related discussions, as informal electronic messages can contain critical information, advice, or commitments that are subject to regulatory oversight. Disregarding these forms of communication represents a significant compliance gap. Professionals should adopt a decision-making framework that prioritizes a thorough understanding of applicable regulations, such as SEC Rule 17A4. This involves proactively designing and implementing systems and procedures that are inherently compliant, rather than attempting to retrofit compliance after the fact. Regular review and auditing of record-keeping practices are essential to ensure ongoing adherence and to adapt to evolving technological landscapes and regulatory interpretations. Question 4. Process analysis reveals that a municipal advisor registered in California is preparing for a routine examination by the Securities and Exchange Commission, SEC. The firm's compliance officer is reviewing the firm's practices for fulfilling the record-keeping requirements outlined in the Securities Exchange Act of 1934, specifically Rule 17A3. Which of the following approaches best ensures the firm's compliance with these regulations? Option A. Instructing all registered representatives to maintain personal notes and readily accessible digital files of all client interactions and transactions, to be compiled only when an SEC examination is imminent. Option B. Implementing and consistently enforcing a detailed internal policy that mandates the creation, maintenance, and timely retention of all records required by Rule 17A3, with clear responsibilities assigned and regular audits conducted. Option C. Relying on the collective memory of senior staff to recall details of past transactions and client communications, and only generating formal documentation if specifically requested by the SEC during an examination. Option D. Creating records only for significant transactions or when a client explicitly requests documentation, with all other information being stored in a shared but unorganized network drive. The correct answer is B. Implementing and consistently enforcing a detailed internal policy that mandates the creation, maintenance, and timely retention of all records required by Rule 17A3, with clear responsibilities assigned and regular audits conducted. Explanation. Scenario analysis. This scenario presents a professional challenge because municipal advisors, like those registered in California, are subject to stringent record-keeping requirements under the Securities Exchange Act of 1934, specifically Rule 17A3. The core of the challenge lies in ensuring that all required records are accurately created, maintained, and readily accessible for examination by regulatory authorities. Failure to do so can result in significant penalties, reputational damage, and harm to investors. The specific nature of municipal advisory activities, which often involve complex transactions and advice to public entities, necessitates meticulous documentation to demonstrate compliance and the basis for recommendations. Correct approach analysis. The best professional practice involves establishing and diligently following a comprehensive internal policy that mandates the creation and retention of all records required by Exchange Act Rule 17A3. This policy should clearly define the types of records to be kept, the designated personnel responsible for their creation and maintenance, the retention periods, and the procedures for ensuring their accuracy and accessibility. For a California-based municipal advisor, this means ensuring that records such as customer account information, transaction records, communications, and any documents related to advice provided to municipal entities are captured and preserved in accordance with SEC regulations. This proactive and systematic approach ensures ongoing compliance and provides a robust defense against potential regulatory scrutiny. Incorrect approaches analysis. One incorrect approach involves relying solely on the memory of individual representatives to recall and produce information when requested by regulators. This method is highly unreliable and fails to meet the explicit requirements of Rule 17A3, which mandates the creation and maintenance of specific records. It introduces a significant risk of incomplete or inaccurate information being provided, leading to regulatory violations. Another unacceptable approach is to only create records when a specific transaction is completed or when a formal request for information is received. Rule 17A3 requires records to be made asterisk at or before the time asterisk of certain events and maintained for specified periods. Delaying record creation until after the fact or only in response to a request bypasses the regulatory intent of having contemporaneous documentation and can lead to the loss of crucial information. A further flawed strategy is to maintain records in an unorganized and disparate manner across various personal devices or unsecured cloud storage. This not only makes it difficult to retrieve information efficiently, but also raises serious concerns about data security and the integrity of the records. Rule 17A3 implies that records should be maintained in a manner that allows for prompt and orderly examination. Professional reasoning. Professionals in California, when dealing with record-keeping obligations under the Securities Exchange Act of 1934, should adopt a policy-driven, systematic approach. This involves understanding the specific requirements of Rule 17A3, implementing robust internal controls and procedures for record creation and retention, and regularly training staff on these policies. The decision-making process should prioritize proactive compliance and the establishment of a culture of meticulous record-keeping, rather than reactive measures or reliance on informal practices. This ensures not only regulatory adherence, but also the firm's operational integrity and the protection of its clients. Question 5. Process analysis reveals that a municipal advisor firm operating in California is seeking to underwrite a significant municipal bond issuance for a California municipality. The firm's compliance department is reviewing potential political contributions that could impact their eligibility. Which of the following actions best ensures compliance with MSRB Rule G37 and California-specific regulations regarding political contributions and municipal securities business? Option A. Allowing contributions to state-level political parties in California, assuming these are broad-based and not directly tied to specific municipal officials involved in awarding underwriting business. Option B. Relying on the firm's general understanding of pay-to-play rules without specific tracking of contributions made by individual employees who are not senior executives. Option C. Waiting for the municipality to award the underwriting business before confirming that no prohibited contributions have been made by any firm personnel. Option D. Implementing a strict internal policy that prohibits any political contributions by the firm, its direct soliciting employees, and their spouses to any elected official or candidate for state or local office in California, and establishing a robust system for monitoring and timely curing any inadvertent violations. The correct answer is D. Implementing a strict internal policy that prohibits any political contributions by the firm, its direct soliciting employees, and their spouses to any elected official or candidate for state or local office in California, and establishing a robust system for monitoring and timely curing any inadvertent violations. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal advisor to navigate the complex landscape of political contributions and their direct impact on their ability to engage in municipal securities business in California. The core difficulty lies in balancing legitimate political engagement with strict regulatory prohibitions designed to prevent quid pro quo corruption and ensure fair competition. A failure to understand and adhere to these rules can lead to severe penalties, including disqualification from municipal securities business. Careful judgment is required to identify and avoid prohibited contributions. Correct approach analysis. The best professional practice involves proactively identifying and understanding the specific prohibitions outlined in Municipal Securities Rulemaking Board, MSRB, Rule G37, as applied to California. This means recognizing that contributions made by the municipal advisor firm, its direct individuals who can solicit business, and their spouses to elected officials or candidates for state or local offices in California, where the firm is seeking or has recently engaged in municipal securities business, are strictly prohibited. The firm must have robust internal compliance procedures to track and prevent such contributions, and if an inadvertent prohibited contribution occurs, it must be disclosed and cured within the stipulated time frame to avoid disqualification. This approach directly aligns with the intent of Rule G37 to maintain the integrity of the municipal market by preventing undue influence. Incorrect approaches analysis. One incorrect approach involves assuming that only direct contributions from the firm's executives are problematic. This overlooks the broader scope of Rule G37, which also prohibits contributions from individuals who can solicit municipal securities business for the firm and their spouses. This failure to consider all covered individuals can lead to inadvertent violations. Another incorrect approach is to believe that if a contribution is made to a political committee that supports multiple candidates, it does not fall under the purview of Rule G37. However, the rule applies regardless of whether the contribution is made directly to an official or indirectly through a political committee, if the intent or effect is to influence the official who can award municipal securities business. A further incorrect approach is to rely solely on the hope that any prohibited contribution will be discovered and addressed after the fact, without implementing proactive compliance measures. Rule G37 emphasizes prevention and timely disclosure and cure. Waiting for discovery rather than actively monitoring and preventing violations demonstrates a lack of due diligence and a disregard for the spirit and letter of the regulation. Professional reasoning. Professionals should adopt a proactive and comprehensive compliance mindset. This involves thoroughly understanding the specific prohibitions of MSRB Rule G37, particularly as they apply to the jurisdictions in which they operate, such as California. Establishing and diligently maintaining internal controls to monitor political contributions made by the firm and covered individuals is paramount. When in doubt, seeking clarification from compliance departments or legal counsel is essential. The decision-making process should prioritize adherence to regulatory requirements and ethical conduct over any perceived benefit from political engagement that could jeopardize the firm's ability to conduct municipal securities business. Question 6. Process analysis reveals that a municipal advisor in Ontario, Canada, is seeking to strengthen relationships with key municipal officials. Considering the strictures of Rule G20 of the Municipal Advisor's Code of Conduct, which of the following actions best aligns with regulatory and ethical obligations regarding gifts, gratuities, non-cash compensation, and expenses of issuance? Option A. Hosting a lavish dinner for a municipal council committee after a successful advisory engagement, exceeding typical business entertainment norms. Option B. Accepting an invitation from a municipal official to attend a private, exclusive golf outing without prior disclosure to the firm's compliance department. Option C. Presenting season tickets to a professional hockey team to a municipal treasurer as a token of appreciation for their cooperation on a recent project. Option D. Offering a small branded item of nominal value, such as a pen or notebook, during a scheduled meeting to discuss an upcoming bond issuance, and ensuring this is documented internally. Correct answer is D. Offering a small branded item of nominal value, such as a pen or notebook, during a scheduled meeting to discuss an upcoming bond issuance, and ensuring this is documented internally. Explanation. Scenario analysis. This scenario presents a common challenge for municipal advisors in Ontario, Canada, where the line between permissible business development activities and prohibited gifts or gratuities can be blurred. Municipal advisors owe a fiduciary duty to their clients, and any compensation or benefit received must be transparent and compliant with regulatory requirements to avoid conflicts of interest and maintain public trust. The pressure to build relationships and secure business can lead to situations where the value or nature of a gift might inadvertently cross regulatory thresholds. Correct approach analysis. The best professional practice involves a strict adherence to the Municipal Advisor's Code of Conduct, specifically Rule G20, which governs gifts, gratuities, non-cash compensation, and expenses of issuance. This approach prioritizes transparency and client interest by ensuring that any item provided is of nominal value, directly related to business discussions, and properly documented, recognizes that the primary obligation is to the client, and that any benefit received must not influence professional judgment or create the appearance of impropriety. This aligns with the ethical imperative to act with integrity and in the best interests of the municipality. Incorrect approaches analysis. Providing a gift of significant value, such as season tickets to a professional sports team, even if intended as a gesture of goodwill, violates Rule G20. Such a gift could be perceived as an attempt to influence the municipal official's decision-making process, creating a conflict of interest and undermining the integrity of the advisory relationship. Similarly, offering to pay for an expensive meal that extends beyond a reasonable business discussion, without clear documentation and client approval, also contravenes the spirit and letter of the rule. This can be seen as an indirect form of compensation or gratuity that is not permissible. Lastly, accepting a gift from a municipal official without disclosing it to the firm's compliance department and potentially the client, or without assessing its compliance with Rule G20, is a serious ethical lapse. This failure to disclose and evaluate the gift's appropriateness can lead to regulatory breaches and damage the firm's reputation. Professional reasoning. Professionals in Ontario's municipal advisory sector must adopt a proactive and conservative approach to gifts and gratuities. When faced with a situation involving potential benefits, the decision-making process should involve 1. Consulting the firm's compliance policies and Rule G20 directly. 2. Assessing the monetary value and nature of the item or service. 3. Determining if it is directly related to a business discussion or client engagement. 4. Prioritizing transparency by documenting all such interactions and seeking internal approval where necessary. 5. Erring on the side of caution. If there is any doubt about compliance, the gift or gratuity should be declined or returned. Question 7. The performance metrics show a consistent pattern of successful bond issuances for the City of Springfield over the past 5 years. As a municipal advisor to the city, you are aware that your firm is also actively seeking to underwrite a significant portion of Springfield's upcoming infrastructure bond issuance, a role that would generate substantial fees for your firm. Considering MSRB Rule G42 in Illinois, which of the following actions best demonstrates compliance with your fair dealing obligations? Option A. Disclose only the potential underwriting role if it represents a direct and immediate financial gain to you personally, rather than to the firm as a whole. Option B. Inform the City of Springfield verbally about your firm's interest in the underwriting role and proceed with advising them, assuming their verbal acknowledgement is sufficient. Option C. Provide the City of Springfield with a written disclosure detailing your firm's intention to seek the underwriting role for the upcoming bond issuance, outlining the potential financial benefit to your firm, and obtain their written consent to continue advising them on the issuance. Option D. Assume that the City of Springfield is aware of your firm's underwriting activities and that the long-standing advisory relationship implies their acceptance of any potential conflicts. Correct answer is C. Provide the City of Springfield with a written disclosure detailing your firm's intention to seek the underwriting role for the upcoming bond issuance, outlining the potential financial benefit to your firm, and obtain their written consent to continue advising them on the issuance. Explanation. This scenario is professionally challenging because it requires a municipal advisor to balance the need to provide comprehensive advice with the strict regulatory requirements of the Municipal Securities Rulemaking Board, MSRB, Rule G42 on fair dealing with municipal entities and obligors. The core tension lies in ensuring that the advice given is not only beneficial to the municipal entity, but also fully compliant with disclosure and conflict of interest rules, particularly when the advisor has a pre-existing relationship or potential future business that could influence their recommendations. Careful judgment is required to navigate these potential conflicts and maintain the trust of the municipal entity. The best approach involves proactively identifying and disclosing all potential conflicts of interest to the municipal entity in writing, as required by MSRB Rule G42. This includes any financial or business relationships that could reasonably be expected to impair the advisor's independence or judgment. The advisor must then obtain the municipal entity's informed consent to proceed with the engagement, despite these disclosed conflicts. This approach is correct because it directly addresses the core tenets of MSRB Rule G42, which mandates fair dealing and robust disclosure to protect municipal entities from undue influence and ensure they can make informed decisions. By disclosing upfront and obtaining consent, the advisor demonstrates transparency and upholds their fiduciary duty. An incorrect approach would be to assume that a long-standing professional relationship negates the need for formal conflict disclosure. MSRB Rule G42 does not provide exceptions for pre-existing relationships. All potential conflicts must be identified and disclosed. Failing to do so violates the rule's requirement for written disclosure and informed consent, potentially leading to a finding of unfair dealing. Another incorrect approach would be to only disclose conflicts that directly benefit the advisor financially, while omitting other potential conflicts, such as those involving affiliated entities or future business opportunities. MSRB Rule G42 requires disclosure of any conflict that could reasonably be expected to impair independence or judgment, regardless of the direct financial benefit to the advisor. This selective disclosure is a failure to meet the comprehensive disclosure requirements of the rule. Finally, an incorrect approach would be to disclose conflicts verbally and then proceed with the engagement without obtaining written confirmation of the municipal entity's understanding and consent. MSRB Rule G42 specifically requires written disclosure and written consent. Verbal communication is insufficient and leaves both parties vulnerable to misunderstandings and regulatory scrutiny. Professionals should employ a decision-making framework that prioritizes proactive identification and transparent disclosure of all potential conflicts of interest. This involves a thorough internal review of all relationships and business activities that could impact advice. When a potential conflict is identified, the advisor must document the conflict, prepare a clear written disclosure for the municipal entity, and obtain written consent before proceeding. This process ensures compliance with MSRB Rule G42 and fosters a relationship of trust and integrity with municipal clients. Question 8. Benchmark analysis indicates that a municipal finance officer in Ontario is exploring options for a new infrastructure project financing. A representative from a firm that provides general municipal finance consulting services, but is not registered as a municipal advisor in Ontario, is meeting with the officer. The officer is seeking to understand the landscape of potential financing avenues. Which of the following approaches by the consulting firm representative would best align with regulatory expectations and professional best practices in Ontario, assuming no formal municipal advisory registration? Option A. Presenting a high-level overview of common municipal financing instruments available in Ontario, such as general obligation bonds, revenue bonds, and provincial infrastructure grants, detailing their general characteristics and typical uses without recommending any specific instrument or strategy. Option B. Recommending a particular type of financing that has been successful for other municipalities of similar size and credit rating in Ontario, based on historical performance data. Option C. Providing a detailed comparative analysis of 3 specific municipal bond structures, including projected interest rates and risk assessments for each, suggesting one structure is likely to be the most advantageous for the municipality's current situation. Option D. Furnishing a curated list of investment dealers known to underwrite municipal debt in Ontario, along with their average underwriting fees for comparable issuances. The correct answer is A. Presenting a high-level overview of common municipal financing instruments available in Ontario, such as general obligation bonds, revenue bonds, and provincial infrastructure grants, detailing their general characteristics and typical uses without recommending any specific instrument or strategy. Explanation. Scenario analysis. This scenario presents a common challenge for municipal advisors in Ontario, Canada, where the line between providing general information and offering specific advice can become blurred. The core difficulty lies in ensuring that communications, especially those involving potential investment opportunities, do not inadvertently constitute advice, as defined by regulatory frameworks, thereby triggering registration and suitability obligations. Municipal advisors must navigate this carefully to avoid misleading issuers or investors, and to maintain compliance with their professional duties. Correct approach analysis. The best professional practice involves clearly distinguishing between providing factual information and offering personalized recommendations. The correct approach is to offer a broad overview of available financing options and their general characteristics, without endorsing any specific product or strategy for the municipality. This approach respects the municipality's autonomy in decision-making and avoids creating a de facto advisory relationship that would necessitate a more formal engagement under Ontario securities law. By focusing on educational content and general market information, the municipal advisor remains within the bounds of permissible activities for unregistered individuals or entities, provided no specific advice is given. Incorrect approach is analysis. Offering a detailed comparison of specific municipal bond structures, including projected yields and risk profiles for each, crosses the line into providing advice. This constitutes a recommendation, even if framed as a comparison, and would likely obligate the individual or firm to register as a municipal advisor and adhere to suitability requirements under Ontario securities law, suggesting a particular type of financing that has historically performed well for similar municipalities, without a thorough analysis of the current municipality's specific financial situation and needs, is also problematic. While seemingly helpful, this implies a level of endorsement and tailored recommendation that goes beyond general information and could be construed as advice. Providing a list of potential underwriters and their typical pricing for municipal debt offerings, without a disclaimer that this is general market information and not a recommendation, could also be interpreted as advisory. The act of compiling and presenting such a list in the context of a potential financing engagement suggests a level of guidance that may trigger regulatory scrutiny. Professional reasoning. Professionals in this field must adopt a proactive stance in clearly defining the scope of their engagement. Before any communication, they should consider whether the information being conveyed is purely informational, or if it could be reasonably interpreted as a recommendation or guidance tailored to the recipient's specific circumstances. When in doubt, it is always best to err on the side of caution and provide only general, factual information, or to formally engage as a registered municipal advisor if the communication is intended to be advisory. Transparency about the nature of the information being provided is paramount. Question. Benchmark analysis indicates that a municipal finance officer in Ontario is exploring options for a new infrastructure project financing. A representative from a firm that provides general municipal finance consulting services, but is not registered as a municipal advisor in Ontario, is meeting with the officer. The officer is seeking to understand the landscape of potential financing avenues. Which of the following approaches by the consulting firm representative would best align with regulatory expectations and professional best practices in Ontario, assuming no formal municipal advisory registration? Options. A. Presenting a high-level overview of common municipal financing instruments available in Ontario, such as general obligation bonds, revenue bonds, and provincial infrastructure grants, detailing their general characteristics and typical uses without recommending any specific instrument or strategy. B. Providing a detailed comparative analysis of 3 specific municipal bond structures, including projected interest rates and risk assessments for each, suggesting one structure is likely to be the most advantageous for the municipality's current situation. C. Recommending a particular type of financing that has been successful for other municipalities of similar size and credit rating in Ontario, based on historical performance data. D. Furnishing a curated list of investment dealers known to underwrite municipal debt in Ontario, along with their average underwriting fees for comparable issuances. Question 9. The risk matrix shows that a registered municipal advisor in California is advising a municipal entity on the structure and terms of an upcoming municipal bond issuance. During the advisory process, the municipal advisor also begins to identify and contact potential institutional investors who might be interested in purchasing these bonds, offering them preliminary information about the deal. Which of the following activities, if undertaken by the municipal advisor, would most likely require them to register as a broker-dealer in addition to their municipal advisor registration for this specific transaction? Option A. Providing advice to the municipal entity on the financial feasibility and terms of the municipal securities issuance. Option B. Assisting the municipal entity in preparing informational materials about the municipal securities for general public dissemination. Option C. Actively soliciting potential investors to purchase the municipal securities and facilitating their investment decisions. Option D. Negotiating the terms of the municipal securities issuance with the municipal entity. The correct answer is A. Providing advice to the municipal entity on the financial feasibility and terms of the municipal securities issuance. Explanation. The risk matrix shows a potential conflict of interest scenario involving a municipal advisor and a potential issuer. The situation is professionally challenging because it requires the municipal advisor to navigate the fine line between providing valuable advice and engaging in activities that could be construed as underwriting or distribution, which would necessitate different registrations and potentially create conflicts. Careful judgment is required to ensure compliance with SEC rules regarding municipal advisor registration and to avoid prohibited activities. The best professional approach involves the municipal advisor clearly defining the scope of their engagement and ensuring their activities strictly adhere to the definition of municipal advisory services under SEC Rule G42. This means providing advice on or for an issuer regarding municipal securities, such as structuring, financial feasibility, or the terms of issuance, without engaging in the sale or underwriting of those securities. By limiting their role to advisory services and avoiding any participation in the distribution or underwriting of the municipal securities, the firm remains compliant with its municipal advisor registration and avoids triggering the need for broker-dealer registration for those specific activities. This approach prioritizes regulatory compliance and ethical conduct by maintaining the distinct roles and responsibilities of a municipal advisor. An incorrect approach would be for the municipal advisor to actively solicit investors for the municipal securities being advised upon. This action moves beyond providing advice and enters the realm of distribution and sales, which is a regulated activity typically requiring broker-dealer registration. Engaging in such solicitation would violate SEC rules by exceeding the scope of municipal advisor activities and potentially acting as an unregistered broker-dealer. Another incorrect approach would be for the municipal advisor to assist the issuer in marketing the municipal securities to potential investors without disclosing their advisory role and the potential conflicts of interest. This lack of transparency and active involvement in the sales process blurs the lines between advisory and underwriting functions, potentially misleading investors and regulators. It also fails to acknowledge that such marketing activities, when performed by a municipal advisor, can be problematic if they are not purely informational and advisory in nature. Finally, an incorrect approach would be for the municipal advisor to interpret their role as including the direct negotiation of the sale of municipal securities to investors on behalf of the issuer. This is a clear indication of underwriting or distribution activities, which are outside the purview of a registered municipal advisor and would necessitate broker-dealer registration. Such an interpretation demonstrates a fundamental misunderstanding of the regulatory distinctions between municipal advisory and broker-dealer functions. Professionals should employ a decision-making framework that begins with a thorough understanding of the SEC's definition of a municipal advisor and the prohibited activities. They must then meticulously assess each proposed action against these definitions, paying close attention to whether the activity constitutes advice or participation in the distribution of municipal securities. When in doubt, seeking clarification from legal counsel or compliance departments is paramount. Maintaining clear documentation of the scope of services and all communications is also crucial for demonstrating compliance. Question 10. Operational review demonstrates that a California municipality is considering issuing $50 million in general obligation bonds with a 20-year term. The estimated annual debt service payments, principal and interest, are $4,000,000. The total estimated issuance costs, underwriter fees, legal, rating, printing, are $750,000. The current market yield for comparable municipal bonds in California is 4.5%. To assess the financial impact, which of the following calculations most accurately represents the net present value, NPV, of this bond issuance, considering the municipality's perspective as the borrower? Option A. Calculate the present value of all future debt service payments using a 4.5% discount rate and subtract the total issuance costs from this sum. Option B. Sum the total interest paid over the life of the bond, subtract this from the principal amount, and then deduct the issuance costs. Option C. Sum the total debt service payments, principal and interest, and subtract the total issuance costs. Option D. Calculate the present value of the principal repayment only using a 4.5% discount rate and subtract the total issuance costs. The correct answer is A. Calculate the present value of all future debt service payments using a 4.5% discount rate and subtract the total issuance costs from this sum. Explanation. This scenario presents a professional challenge because it requires a municipal advisor to accurately calculate the net present value of a proposed bond issuance, considering various cost components and the time value of money, while adhering to the specific disclosure and fiduciary duties mandated by the Municipal Securities Rulemaking Board, MSRB, and Securities and Exchange Commission, SEC. Regulations applicable in California. Miscalculating this crucial metric can lead to an inaccurate assessment of the project's financial viability, potentially resulting in a detrimental outcome for the municipal issuer and its constituents, and a breach of the advisor's duty of care. The best approach involves a precise calculation of the net present value, NPV, using the appropriate discount rate, which reflects the true cost of borrowing for the municipality. This method accurately accounts for the present value of all future cash flows, including the principal and interest payments, offset by the initial issuance costs. The formula for NPV is \NPV equals \sum t equals 0 n \frac CFT, 1 plus RT where CFT is the cash flow at time \T \R is the discount rate, representing the yield on the bonds, and \N is the number of periods. In this context, the initial issuance costs are a negative cash flow at \T equals 0 and the debt service payments are negative cash flows in subsequent periods. The calculation must be performed meticulously, ensuring all relevant costs, underwriter fees, legal fees, rating agency fees, printing costs, are included as part of the initial outlay. This rigorous and accurate financial modeling aligns with the MSRB Rule G44 regarding the duty of care owed by municipal advisors and the SEC's anti-fraud provisions, ensuring that advice provided is based on sound financial principles and complete information. An approach that simply sums the total interest paid over the life of the bond and subtracts it from the principal amount, then deducts issuance costs, is incorrect. This method fails to account for the time value of money, which is a fundamental principle in financial analysis. The value of money today is different from its value in the future due to its earning potential. Ignoring this leads to a distorted understanding of the true cost of the debt. This oversight constitutes a failure to exercise the required duty of care under MSRB Rule G44, as it does not provide a financially sound basis for advice. Another incorrect approach is to calculate the total debt service payments, principal and interest, and subtract only the principal amount, then deduct issuance costs. This is flawed because it does not properly incorporate the interest payments into a present value calculation. The interest payments are a significant cost of borrowing and must be discounted back to their present value to accurately reflect the total financial burden of the debt. This omission also violates the duty of care by presenting an incomplete and misleading financial picture. Finally, an approach that calculates the NPV using a discount rate that does not reflect the actual market yield for similar municipal bonds in California is also incorrect. The discount rate is critical for accurately determining the present value of future cash flows. Using an arbitrary or inappropriate rate, such as the municipality's general fund interest rate, would not accurately reflect the cost of this specific debt issuance. This misrepresentation of the cost of borrowing would violate the MSRB fair dealing provisions and the advisor's fiduciary duty to act in the best interest of the municipal issuer. Professionals should adopt a systematic approach to NPV calculations, ensuring all relevant costs and cash flows are identified. The correct discount rate, market yield, is used, and the calculation is performed with precision. This involves understanding the specific regulatory requirements of the MSRB and SEC, particularly concerning the duty of care and disclosure obligations for municipal advisors in California. When faced with complex financial calculations, professionals should always err on the side of thoroughness and accuracy, seeking clarification or expert assistance if necessary to ensure the advice provided is sound and compliant. Question 11. The efficiency study reveals that a municipal advisor in California is advising a city on a complex new revenue bond issuance. The advisor has a limited time frame to provide recommendations due to the city's pressing need to finance infrastructure projects. The advisor receives a substantial amount of financial data and projections from the city's finance department. Which of the following approaches best aligns with the MSRB rules governing the activities of municipal advisors, particularly concerning professional qualification and due diligence? Option A. Develop a detailed due diligence checklist tailored to the specific revenue bond issuance. Proactively seek clarification on any ambiguous data. Conduct independent verification of key financial assumptions where feasible, and maintain thorough documentation of all inquiries and findings to ensure the city is fully informed of all material risks and benefits. Option B. Rely primarily on the representations and assurances provided by the city's finance department regarding the accuracy and completeness of the financial data and projections, assuming their expertise and integrity. Option C. Delegate the majority of the due diligence tasks to junior analysts with minimal oversight, focusing only on the most obvious and easily verifiable data points to expedite the process. Option D. Prioritize speed by accepting the provided financial data and projections at face value, addressing only the most glaring inconsistencies and deferring deeper analysis to a later stage if issues arise. The correct answer is A. Develop a detailed due diligence checklist tailored to the specific revenue bond issuance, proactively seek clarification on any ambiguous data, conduct independent verification of key financial assumptions where feasible, and maintain thorough documentation of all inquiries and findings to ensure the city is fully informed of all material risks and benefits. Explanation: the efficiency study reveals a common challenge for municipal advisors, balancing the need for comprehensive due diligence with the practical constraints of time and resources when advising on complex municipal financings. This scenario is professionally challenging because a municipal advisor owes a fiduciary duty to its municipal entity client, requiring them to act with the highest standard of care. This duty necessitates thorough investigation and analysis, but the pressure to deliver timely advice can create a tension between diligence and expediency. Careful judgment is required to ensure that all material risks and benefits are identified and communicated without undue delay. The best approach involves a systematic and documented process that prioritizes critical areas of inquiry while acknowledging the need for efficiency. This includes developing a structured due diligence checklist tailored to the specific transaction, engaging with relevant parties to gather information promptly, and documenting all findings and communications. The advisor must proactively identify potential red flags and escalate concerns to the municipal entity client for discussion and decision-making. This methodical and transparent process ensures that the municipal entity client is fully informed and can make decisions based on a comprehensive understanding of the risks and benefits, thereby fulfilling the advisor's fiduciary duty under MSRB Rule G44 and related guidance on professional qualification and conduct. An approach that relies heavily on the issuer's representations without independent verification, even if time-saving, fails to meet the standard of care required of a municipal advisor. While issuers provide information, the advisor's role is to independently assess its reasonableness and completeness, especially concerning financial projections and market conditions. This failure to conduct adequate independent verification constitutes a breach of the fiduciary duty. Another unacceptable approach is to delegate significant portions of the due diligence to junior staff without sufficient oversight or review by experienced professionals. While delegation is necessary for efficiency, the ultimate responsibility for the quality and completeness of the advice rests with the municipal advisor. Insufficient oversight can lead to missed critical information or misinterpretation of data, jeopardizing the municipal entity client's interests and violating MSRB standards for professional competence. Finally, an approach that prioritizes speed over thoroughness by glossing over potential inconsistencies or uncertainties in the provided information is also professionally unsound. The MSRB rules emphasize the importance of acting with integrity and in the best interests of the municipal entity client. Ignoring or downplaying potential issues, even with the intention of expediting the process, can lead to significant financial harm for the issuer and a violation of the advisor's ethical and regulatory obligations. Professionals should employ a decision-making framework that begins with a clear understanding of the MSRB expectations for municipal advisors, particularly regarding their fiduciary duties and professional qualifications. This involves establishing robust internal policies and procedures for due diligence, risk assessment, and client communication. When faced with time pressures, professionals should prioritize critical areas of inquiry, document their decision-making process for any deviations from standard procedures, and maintain open and transparent communication with their municipal entity clients about the scope and limitations of their review. Question 12. During the evaluation of a potential new municipal advisory engagement in California, a municipal advisor representative realizes that a key analyst on their team, who will be instrumental in developing the financial strategy for the issuer, has not yet passed the Series 50 exam. The engagement is time-sensitive, and the issuer is eager to move forward. What is the most appropriate course of action for the municipal advisor representative and their firm? Option A. The representative should allow the analyst to continue providing advice and developing strategies, with the understanding that the analyst will attempt the Series 50 exam as soon as possible after the engagement concludes. Option B. The representative should ensure the analyst is immediately registered as a municipal advisor representative and actively pursues passing the Series 50 exam, while closely supervising their work and limiting their direct client interaction until qualification is achieved. Option C. The representative should inform the issuer that the engagement must be delayed until the analyst has successfully passed the Series 50 exam, even if this causes significant inconvenience. Option D. The representative can proceed with the engagement as planned, as the analyst's extensive experience in municipal finance is sufficient to meet the spirit of the MSRB qualification requirements. The correct answer is B. The representative should ensure the analyst is immediately registered as a municipal advisor representative and actively pursues passing the Series 50 exam, while closely supervising their work and limiting their direct client interaction until qualification is achieved. Explanation: this scenario is professionally challenging because it requires a municipal advisor representative to navigate the nuances of professional qualification requirements under Rule G3 of the Municipal Securities Rulemaking Board, MSRB, while facing pressure to complete a transaction. The representative must balance the urgency of client needs with the strict regulatory mandate for qualification. Careful judgment is required to ensure compliance without unduly delaying essential services. The best professional approach involves proactively identifying and addressing any potential qualification gaps before undertaking significant advisory activities. This means verifying that all individuals involved in providing advice or recommendations meet the MSRB professional qualification standards, including passing the appropriate examinations. If an individual has not yet met these requirements, the firm must ensure they are properly supervised and that their activities are limited to those permissible for unregistered personnel until they achieve the necessary qualifications. This aligns directly with the MSRB intent to ensure that only qualified individuals provide advice to municipal entities and obligated persons, thereby protecting investors and the integrity of the municipal market. An incorrect approach involves proceeding with advisory services without confirming that all personnel involved meet the Rule G3 qualification requirements. This failure to verify qualifications is a direct violation of MSRB Rule G3, which mandates that firms ensure their associated persons are properly qualified. Another incorrect approach is to assume that because a person has experience in municipal finance, they automatically meet the qualification standards. Rule G3 specifically requires passing designated examinations, and experience alone is insufficient. Furthermore, relying solely on the client's understanding of the representative's qualifications, rather than the firm's internal compliance, is a significant ethical and regulatory lapse. The responsibility for ensuring compliance rests with the municipal advisor firm and its associated persons. Professionals should employ a decision-making framework that prioritizes regulatory compliance. This involves a proactive compliance culture, where qualification requirements are regularly reviewed and verified for all personnel. When faced with a situation where qualification is in question, the professional should immediately consult internal compliance procedures and seek guidance from their compliance department. The default action should be to halt or limit advisory activities until full compliance is achieved, rather than risking a violation. Question 13. What factors determine the appropriate pricing strategy for a municipal bond issuance in California when a municipal advisor has identified a pricing proposal that offers a higher fee to the advisor but may not represent the absolute best market price for the issuer? Option A. The municipal advisor's disclosure of a more favorable pricing offered to a potential underwriter in exchange for a commitment to a higher advisor fee, without first consulting the issuer. Option B. The municipal advisor's ability to negotiate a higher fee with the issuer by presenting a pricing proposal that meets a minimum acceptable yield for the issuer, even if other options might offer better terms. Option C. The municipal advisor's acceptance of a pricing proposal based on the perceived marketability of the bonds, without conducting independent verification of the price competitiveness. Option D. The municipal advisor's fiduciary duty to secure the most advantageous pricing for the municipal issuer, even if it means accepting a lower fee, and ensuring full transparency with the issuer regarding all pricing options. The correct answer is D. The municipal advisor's fiduciary duty to secure the most advantageous pricing for the municipal issuer, even if it means accepting a lower fee, and ensuring full transparency with the issuer regarding all pricing options. Explanation: this scenario presents a professional challenge because it requires a municipal advisor to navigate the complex interplay between their fiduciary duty to a municipal entity and the potential for personal gain or the appearance of impropriety. The core of the challenge lies in ensuring that the pricing of municipal securities is conducted with the utmost integrity, transparency, and in the best interests of the client, while also adhering to specific regulatory requirements in California. The best professional approach involves prioritizing the client's interests above all else, even when faced with a situation that could lead to personal benefit. This means actively seeking the most advantageous pricing for the municipal issuer, which includes exploring all available avenues for competitive bids and ensuring that the final price reflects fair market value. This approach aligns with the fiduciary duty of a municipal advisor, as mandated by the Securities Exchange Act of 1934 and enforced by the Municipal Securities Rulemaking Board (MSRB) rules, which require municipal advisors to act with the highest standard of care. Specifically, MSRB Rule G42 on duties of non-solicited financial intermediaries emphasizes acting in the best interest of the municipal entity. In California, this fiduciary duty is further reinforced by state regulations governing municipal advisors. Therefore, diligently working to secure the best possible price, even if it means foregoing a potentially higher fee, is the ethically and regulatorily sound path. An incorrect approach would be to accept a pricing proposal that, while meeting a minimum acceptable threshold for the issuer, is not demonstrably the best available in the market, simply because it offers a higher fee to the advisor. This would violate the fiduciary duty to act in the best interest of the municipal entity. Such an action could be construed as prioritizing personal gain over client welfare, a direct contravention of MSRB Rule G42 and California's regulatory framework for municipal advisors. Another incorrect approach would be to disclose the existence of a more favorable pricing offer to a potential underwriter in exchange for a commitment to a higher fee, without first presenting this information to the municipal issuer for their decision. This action breaches confidentiality and undermines the issuer's ability to make an informed decision about their financing. It also creates an appearance of impropriety and could be seen as an attempt to manipulate the pricing process for personal benefit, violating the principles of fair dealing and transparency required by both MSRB rules and California law. Finally, an approach that involves accepting a pricing proposal without conducting adequate due diligence to confirm its competitiveness would also be professionally unacceptable. This failure to verify the fairness of the price, even if the fee structure is acceptable, demonstrates a lack of diligence and a potential disregard for the client's financial well-being. It falls short of the standard of care expected of a municipal advisor and could expose both the advisor and the issuer to financial risks. Professionals should employ a decision-making process that begins with a clear understanding of their fiduciary obligation. This involves always asking, is this action in the absolute best interest of my municipal client? Any potential for personal gain must be secondary to this primary consideration. Thorough due diligence, transparent communication with the client, and a commitment to securing the most advantageous terms for the issuer, regardless of the impact on the advisor's fee, are essential components of ethical and compliant practice. Question 14. Process analysis reveals that a municipal advisor is tasked with providing guidance on a potential bond issuance for a new infrastructure project in California. The advisor is aware that the State Treasurer of California is a key figure in state finance, but also recognizes that various state agencies and departments operate as instrumentalities with their own financial responsibilities. What is the most critical step for the municipal advisor to take to ensure compliance and provide sound advice regarding the issuer participants in this scenario? Option A. Treat all California state instrumentalities as having identical financial powers and objectives, regardless of their specific mandates. Option B. Thoroughly research and document the specific statutory authority of the State Treasurer of California and its relationship with other state instrumentalities, understanding their distinct legal powers and responsibilities as defined by California law. Option C. Assume the State Treasurer of California has ultimate and exclusive authority over all financial decisions and bond issuances for any state instrumentality. Option D. Rely primarily on informal discussions and past practices with specific state agencies to determine their financial decision-making authority. The correct answer is B. Thoroughly research and document the specific statutory authority of the State Treasurer of California and its relationship with other state instrumentalities, understanding their distinct legal powers and responsibilities as defined by California law. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a municipal advisor to navigate the complex relationship between a state government issuer and its various instrumentalities, specifically focusing on the state treasurer's role. The advisor must understand the distinct legal and financial authorities of each entity to provide accurate and compliant advice, especially when dealing with potential conflicts of interest or differing priorities among state agencies. Misinterpreting these relationships can lead to noncompliance with state laws and federal regulations governing municipal advisors, potentially resulting in significant penalties for both the advisor and the issuer. Correct approach analysis. The best professional practice involves a thorough understanding of the specific statutory authority granted to the State Treasurer of California and its relationship with other state agencies. This includes recognizing that, while the Treasurer is a key fiscal officer, other state instrumentalities may have independent authority for certain financial decisions or bond issuances, as defined by California law. A municipal advisor must meticulously research and document the legal framework governing each entity involved to ensure advice aligns with their respective powers and responsibilities, thereby upholding their fiduciary duty and regulatory compliance. Incorrect approach is analysis. One incorrect approach would be to assume the State Treasurer of California has overarching and exclusive authority over all financial decisions and bond issuances of every state instrumentality. This fails to acknowledge that California law may delegate specific financial powers to other state agencies or departments, and treating the treasurer as the sole decision-maker for all matters would be a misinterpretation of the legal structure. This could lead to providing advice that is outside the scope of the treasurer's authority or that bypasses necessary approvals from other relevant state bodies. Another incorrect approach is to rely solely on informal communications or past practices with a particular state agency without verifying the current legal basis for their actions. While relationships and procedures can evolve, municipal advisory duties are grounded in formal legal authority. Basing advice on informal understandings rather than documented statutory powers risks advising on actions that are not legally permissible or that could be challenged, leading to regulatory noncompliance and potential legal repercussions. A further incorrect approach is to treat all state instrumentalities as monolithic entities with identical financial powers and objectives. California, like other states, has a diverse range of agencies, each with its own mandate, funding sources, and governance. Failing to differentiate these specific powers and responsibilities when providing advice can result in recommendations that are inappropriate for a particular instrumentality, potentially leading to inefficient financial management or non-compliance with specific state statutes governing that agency. Professional reasoning. Professionals should adopt a systematic approach to understanding issuer participants. This involves 1. Identifying all relevant entities involved in a potential transaction. 2. Researching the specific statutory and regulatory authority of each entity, with a particular focus on the powers and limitations of the state treasurer and other state instrumentalities within the relevant state's legal framework, in this case, California. 3. Documenting this research to support all advice provided. 4. Continuously verifying that advice aligns with the legal powers and responsibilities of each specific entity and adheres to all applicable municipal advisor regulations. Question 15. Market research demonstrates that municipalities often face urgent funding needs. In California, a municipal advisor is assisting a city council that requires immediate capital for infrastructure repairs. The advisor has identified a financing option that can be executed very quickly, but carries slightly higher interest rates and fees compared to other, more complex structures that would require more time for due diligence and negotiation. The advisor must recommend a course of action. Which of the following approaches best upholds the advisor's fiduciary duty and record-keeping obligations? Option A. Conduct thorough due diligence on all available financing options, analyze the long-term financial implications of each, and meticulously document all research, communications, and the rationale for the final recommendation, even if it means a slightly longer execution timeline. Option B. Rely on the City Council's initial preference for the fastest financing method without conducting independent analysis, assuming their understanding of their needs is sufficient. Option C. Recommend the quickest financing option available to meet the city's immediate needs, focusing primarily on the speed of execution rather than a detailed analysis of long-term costs. Option D. Present multiple financing options to the City Council, but prioritize the option that offers the advisor the most favorable compensation, ensuring to disclose any potential conflicts of interest. The correct answer is A. Conduct thorough due diligence on all available financing options, analyze the long-term financial implications of each, and meticulously document all research, communications, and the rationale for the final recommendation, even if it means a slightly longer execution timeline. Explanation: this scenario is professionally challenging because it requires a municipal advisor to balance the immediate financial needs of a municipality with their long-term fiduciary obligations and the stringent record-keeping requirements mandated by the Securities and Exchange Commission, SEC, and state securities laws in California. The advisor must act with the highest degree of care and loyalty, prioritizing the municipality's best interests above their own or those of any third party. The pressure to secure immediate funding can create a temptation to overlook crucial due diligence or to document decisions inadequately, which can have severe legal and ethical consequences. The correct approach involves a comprehensive review of all relevant financial information, including the municipality's existing debt obligations, revenue streams, and projected future financial performance. This includes conducting thorough due diligence on potential financing structures and lenders, ensuring that any proposed solution is not only timely, but also the most advantageous for the municipality in the long run. Crucially, all communication, analyses, and decision-making processes must be meticulously documented. This documentation serves as evidence of the advisor's adherence to their fiduciary duty, demonstrating that all recommendations were made in the municipality's best interest and were supported by sound analysis. This aligns with SEC Rule 15-1-1, which mandates that municipal advisors maintain records of their advice and recommendations, and with the general principles of fiduciary duty under California law, which requires advisors to act with utmost good faith and loyalty. An incorrect approach would be to prioritize securing the fastest financing option without adequately assessing its long-term implications or the availability of more favorable alternatives. This fails to uphold the fiduciary duty of care and loyalty, as it potentially exposes the municipality to suboptimal terms or excessive costs. Furthermore, neglecting to document the rationale behind the chosen financing structure or the due diligence performed would violate SEC record-keeping requirements and create a significant risk of regulatory scrutiny and legal liability. Another incorrect approach involves relying solely on the municipality's stated preference for a particular financing method without independent verification or analysis. While client preferences are important, a fiduciary advisor has an independent obligation to provide objective advice based on thorough research and analysis, even if that advice contradicts the client's initial inclination. Failing to conduct independent due diligence and document the process demonstrates a lack of professional rigor and a potential abdication of fiduciary responsibility. Finally, an approach that involves accepting incentives or compensation structures that could create a conflict of interest, even if disclosed, is problematic. While disclosure is a component of managing conflicts, a true fiduciary advisor must ensure that their compensation is reasonable and does not compromise their ability to provide unbiased advice. Prioritizing personal gain over the municipality's financial well-being is a direct violation of fiduciary duty and California's regulations governing municipal advisors. Professionals should employ a decision-making framework that begins with a clear understanding of their fiduciary obligations. This involves a commitment to acting solely in the client's best interest, conducting thorough due diligence, providing objective and informed advice, and maintaining meticulous records. When faced with competing pressures, such as the need for speed versus the need for optimal terms, professionals must always default to the option that best serves the client's long-term interests, supported by robust documentation. Question 16. Process analysis reveals that a municipal entity in California is considering issuing new bonds to finance infrastructure projects. To ensure a compliant and successful issuance, what is the most appropriate initial step in identifying and engaging the necessary participants for this municipal securities offering? Option A. Prioritize securing bond counsel for the issuer and underwriter's counsel before any other professional engagement. Option B. Engage a municipal advisor to provide fiduciary advice on structuring the issuance and identifying other required professionals. Option C. Rely solely on the municipal entity's internal finance department to manage all aspects of the issuance and identify external needs. Option D. Directly engage an underwriter to manage the sale of the bonds and coordinate the involvement of other parties. The correct answer is B. Engage a municipal advisor to provide fiduciary advice on structuring the issuance and identifying other required professionals. Explanation. Scenario analysis. This scenario is professionally challenging because the issuance of municipal securities involves a complex web of participants, each with distinct roles and responsibilities. Misunderstanding or misassigning these roles can lead to regulatory violation, operational inefficiencies, and ultimately, a flawed or non-compliant issuance process. Ensuring all necessary parties are identified and their functions are properly understood is paramount for a successful and lawful municipal offering. Correct approach analysis. The best professional practice involves identifying and engaging the municipal advisor, MA, as the primary fiduciary responsible for advising the municipal entity on the issuance. The MA's role is to provide impartial advice, conduct feasibility studies, assist in structuring the debt, and help select other professionals. This approach is correct because under the Securities Exchange Act of 1934, specifically Rule G44, and related guidance from the Municipal Securities Rulemaking Board, MSRB, municipal advisors owe a fiduciary duty to their municipal entity clients. This duty mandates acting in the best interest of the client, which includes ensuring all necessary roles for a successful issuance are identified and filled appropriately, such as legal counsel for both the issuer and underwriters, and the underwriter, themselves who will purchase and resell the securities. Incorrect approach is analysis. One incorrect approach is to solely rely on the underwriter to identify and coordinate all necessary participants. While underwriters play a crucial role in the distribution of municipal securities, their primary interest is in purchasing and reselling the bonds for profit. They are not fiduciaries to the municipal entity, in the same way a municipal advisor is. This approach fails to uphold the fiduciary duty owed by the municipal advisor and can lead to advice that prioritizes the underwriter's interests over the issuer's. Another incorrect approach is to assume that the municipal entity's internal staff can manage the entire issuance process without external specialized expertise. While internal staff are vital for providing information and making decisions, the complexity of municipal finance, securities laws, and market practices necessitates the involvement of experienced professionals like municipal advisors, bond counsel, and underwriters. Overlooking these specialized roles can result in significant legal and financial risks for the issuer. A further incorrect approach is to prioritize engaging only the legal counsel for the municipal entity and the underwriter, without first establishing the role of a municipal advisor. Legal counsel provides essential advice on legal and regulatory matters, but they do not typically provide the comprehensive financial and structural advice that a municipal advisor does. Without a municipal advisor, the issuer may not receive objective advice on the best way to structure the debt, assess feasibility, or select appropriate financing methods, thereby compromising the fiduciary obligation. Professional reasoning. Professionals should adopt a structured approach to identifying participants in a municipal issuance. This begins with recognizing the central role of the municipal advisor as the fiduciary responsible for guiding the municipal entity through the entire process. The municipal advisor then assists in identifying and selecting other critical parties, such as bond counsel for the issuer, underwriter's counsel, and the underwriter. This layered approach ensures that the issuer's interests are protected by a fiduciary, while leveraging the expertise of other necessary professionals for a compliant and effective issuance. Question 17. Process analysis reveals that a municipal advisor in California, which also operates as an investment advisor through an affiliated entity, is advising a municipal entity on the issuance of bonds. The municipal entity intends to invest the proceeds of these bonds. What is the most compliant course of action for the municipal advisor regarding the investment of these bond proceeds? Option A. Recommend an investment strategy for the bond proceeds, and if the municipal entity chooses to invest with the municipal advisor's affiliate, ensure full disclosure of the affiliate relationship and the potential for the municipal advisor to receive compensation indirectly. Option B. Proceed with recommending an investment strategy for the bond proceeds without seeking independent advice, as the municipal advisor believes their affiliate's proposed strategy is the most beneficial for the municipal entity. Option C. Advise the municipal entity to seek investment advice from an entirely separate, unaffiliated investment advisor for the bond proceeds, and the municipal advisor will only focus on the bond issuance aspects. Option D. Assume that since the municipal advisor's affiliate will be managing the investments, the MSRB rules governing municipal advisors are less stringent for this portion of the engagement. Correct answer is A. Recommend an investment strategy for the bond proceeds, and if the municipal entity chooses to invest with the municipal advisor's affiliate, ensure full disclosure of the affiliate relationship and the potential for the municipal advisor to receive compensation indirectly. Explanation. This scenario presents a professional challenge because it requires a municipal advisor to navigate the complex interplay between advising on the investment of municipal bond proceeds and the potential for conflicts of interest arising from their role as an investment advisor. The Municipal Securities Rulemaking Board, MSRB, Rule G23, concerning municipal fund securities and investment advisors, is central to ensuring that municipal advisors act in the best interests of their municipal entity clients and avoid conflicts of interest. The core difficulty lies in ensuring that advice regarding the investment of bond proceeds is solely driven by the municipal entity's needs and not influenced by the advisor's own investment advisory business or potential for additional fees. The correct approach involves a clear separation of roles and a robust disclosure process. When a municipal advisor also acts as an investment advisor for the same municipal entity, they must ensure that any advice provided regarding the investment of bond proceeds is consistent with their fiduciary duty as a municipal advisor, and that any potential conflicts are fully disclosed and managed. This includes obtaining independent advice on the investment strategy for the bond proceeds if the municipal advisor's affiliate is to manage those investments. This approach aligns with MSRB Rule G23 emphasis on avoiding conflicts of interest and acting in the best interest of the municipal entity. An incorrect approach would be to proceed with recommending an investment strategy for the bond proceeds without obtaining independent advice, even if the municipal advisor believes their affiliate's strategy is superior. This fails to address the inherent conflict of interest, where the municipal advisor stands to benefit from their affiliate managing the invested proceeds. Such an action violates the spirit and letter of MSRB Rule G23, which mandates that municipal advisors take steps to ensure their advice is objective and not influenced by their own or their affiliate's financial interests. Another incorrect approach is to assume that simply disclosing the affiliate relationship is sufficient. While disclosure is a component of managing conflicts, it is not a substitute for taking concrete steps to mitigate the conflict, such as obtaining independent advice. MSRB Rule G23 requires more than just transparency. It requires active management of the conflict to ensure the municipal entity receives unbiased advice. Finally, an incorrect approach would be to argue that since the municipal advisor is acting within their capacity as an investment advisor for the bond proceeds, the rules governing municipal advisors do not fully apply. This is a misinterpretation of the regulatory framework. When a firm acts as a municipal advisor, it is subject to the MSRB rules governing municipal advisors, regardless of other roles it may hold. The fiduciary duty and conflict of interest provisions of MSRB Rule G23 are paramount. Professionals should approach such situations by first identifying potential conflicts of interest inherent in their dual roles. They must then consult the relevant MSRB rules, particularly Rule G23, to understand their obligations. The decision-making process should prioritize the municipal entity's best interests, which may necessitate seeking independent advice or recusing themselves from certain aspects of the transaction to ensure objectivity and compliance. Question 18. Process analysis reveals that a municipal advisor in California, tasked with advising a public pension fund on the financial feasibility of a significant infrastructure project, has received preliminary projections from the project proponents that appear favorable. What is the most appropriate course of action for the municipal advisor to fulfill their regulatory and ethical obligations? Option A. Recommend the project to the pension fund based on the favorable preliminary projections, emphasizing the potential for increased management fees for the advisor's firm. Option B. Conduct an independent and comprehensive financial feasibility study, rigorously assessing all revenue, cost, and risk factors, and present an objective analysis and recommendation to the pension fund. Option C. Accept the projections provided by the project proponents at face value and present them to the pension fund without independent verification or further analysis. Option D. Prepare a feasibility report that highlights the positive aspects of the project while minimizing or omitting any significant risks or potential cost overruns. The correct answer is B. Conduct an independent and comprehensive financial feasibility study, rigorously assessing all revenue, cost, and risk factors, and present an objective analysis and recommendation to the pension fund. Explanation. Scenario analysis. This scenario presents a professional challenge for a municipal advisor to a public pension fund in California. The core difficulty lies in balancing the fiduciary duty to the pension fund with the need to provide objective, unbiased advice regarding the financial feasibility of a proposed infrastructure project. The advisor must navigate potential conflicts of interest and ensure that their recommendations are based on sound financial analysis and are in the best long-term interest of the fund's beneficiaries. Adhering strictly to California's specific regulatory framework for municipal advisors, correct approach analysis. The best professional practice involves conducting a comprehensive, independent financial feasibility study that thoroughly analyzes all potential revenue streams, operating costs, capital expenditures, and debt service requirements associated with the proposed project. This study must also assess the project's impact on the pension fund's overall asset allocation, risk profile, and ability to meet its long-term liabilities. The advisor should then present a clear, objective report detailing the findings, including any identified risks and uncertainties, and provide a reasoned recommendation based solely on the financial merits and alignment with the pension fund's investment policy and fiduciary responsibilities. This approach aligns with the Municipal Securities Rulemaking Board, MSRB, Rule G42 on duties of non-solicitor municipal advisors, which mandates acting with diligence and care, providing advice that is fair and in the best interest of the client, and disclosing conflicts of interest. California law further emphasizes the fiduciary duty of public pension fund fiduciaries to act solely in the interest of plan participants and beneficiaries. Incorrect approaches analysis. Recommending the project based primarily on the potential for increased management fees for the advisor's firm, without a thorough independent financial feasibility study, constitutes a significant ethical and regulatory failure. This prioritizes the advisor's self-interest over the pension fund's beneficiaries, violating the fiduciary duty and MSRB Rule G42 requirement for advice to be in the client's best interest. Furthermore, it fails to comply with the diligence and care standards. Presenting a feasibility study that selectively highlights positive aspects while downplaying or omitting significant risks and costs is also a violation. This misrepresents the project's true financial viability and breaches the duty of care and fair dealing. Relying solely on projections provided by the project proponents without independent verification or critical analysis is another failure. This demonstrates a lack of diligence and care, as the advisor has not independently assessed the reasonableness and accuracy of the projections, potentially leading to flawed advice and a breach of fiduciary duty. Professional reasoning. Professionals should approach such situations by first identifying their role and the associated fiduciary duties under applicable regulations, such as MSRB Rule G42 and California state law governing public pension funds. A critical step is to proactively identify and disclose any potential conflicts of interest. The decision-making process should then focus on conducting a rigorous, independent analysis that prioritizes the client's best interests. This involves gathering all relevant data, performing thorough due diligence, critically evaluating all assumptions, and considering a range of potential outcomes, including adverse scenarios. The final recommendation must be supported by objective findings and clearly articulated reasoning, ensuring transparency and accountability. Question 19. Compliance review shows that a municipal advisor in California is assisting a school district with a bond issuance. To select underwriters for the transaction, the advisor is considering several approaches. Which of the following selection criteria development approaches best aligns with MSRB Rule G45 and the advisor's duty of care to the issuer? Option A. Choose underwriters who have previously provided the municipal advisor with valuable referrals for other advisory business, believing this indicates a strong working partnership. Option B. Select underwriters primarily based on the lowest proposed underwriting spread, without significant consideration of their experience or proposed services. Option C. Prioritize underwriters based on long-standing personal relationships the municipal advisor has with their representatives, assuming these relationships facilitate smoother transaction execution. Option D. Develop objective criteria that assess each underwriter's experience with similar municipal financings, their financial strength, their understanding of the school district's specific financial needs and market, and their proposed fee structure and services. The correct answer is D. Develop objective criteria that assess each underwriter's experience with similar municipal financings, their financial strength, their understanding of the school district's specific financial needs and market, and their proposed fee structure and services. Explanation. This scenario is professionally challenging because selecting participants for an issuer transaction, particularly in the context of municipal advisory services in California, requires a delicate balance between efficiency, fairness, and strict adherence to regulatory requirements designed to protect municipal entities and their investors. The Municipal Securities Rulemaking Board, MSRB, Rule G45, as interpreted and enforced by FINRA, mandates that municipal advisors act with diligence and care, and this extends to the selection process for parties involved in an issuer's transaction. The core challenge lies in ensuring that the selection process is not influenced by conflicts of interest, is transparent, and ultimately serves the best interests of the municipal issuer. The correct approach involves establishing objective, predefined criteria that are directly related to the issuer's needs and the specific requirements of the transaction. This typically includes evaluating potential participants based on their experience with similar transactions, their financial stability, their understanding of the issuer's specific market and needs, and their proposed fees and services. This method aligns with MSRB Rule G45, emphasis on acting in the best interests of the issuer and avoiding conflicts of interest. By having clear, documented criteria, the municipal advisor can demonstrate that the selection was made impartially and with due diligence, thereby fulfilling their fiduciary duty and regulatory obligations. An incorrect approach would be to prioritize participants based on existing relationships or the perceived ease of working with them, without a formal evaluation against objective criteria. This introduces a significant risk of actual or perceived conflicts of interest, potentially leading to the selection of a less qualified or more expensive participant. Such a practice violates the MSRB principles of fair dealing and acting in the best interests of the issuer. Another incorrect approach is to select participants based solely on the lowest proposed fee. While cost is a factor, it should not be the sole determinant. This can lead to the selection of less experienced or less capable firms, potentially resulting in a suboptimal transaction for the issuer, which is contrary to the duty of care. Finally, selecting participants based on their ability to provide future business opportunities to the municipal advisor is a clear violation of MSRB rules regarding conflicts of interest and fair dealing. This prioritizes the advisor's self-interest over the issuer's best interests and undermines the integrity of the municipal advisory process. Professionals should approach participant selection by first understanding the issuer's specific needs and the transaction's objectives. They should then develop a written request for proposals (RFP) or similar document outlining objective selection criteria. This process should be documented thoroughly, including the evaluation of each potential participant against these criteria, to ensure transparency and compliance with regulatory standards. Question: compliance review shows that a municipal advisor in California is assisting a school district with a bond issuance. To select underwriters for the transaction, the advisor is considering several approaches. Which of the following selection criteria development approaches best aligns with MSRB Rule G45 and the advisor's duty of care to the issuer? Options: A. Develop objective criteria that assess each underwriter's experience with similar municipal financings, their financial strength, their understanding of the school district's specific financial needs and market, and their proposed fee structure and services. B. Prioritize underwriters based on long-standing personal relationships the municipal advisor has with their representatives, assuming these relationships facilitate smoother transaction execution. C. Select underwriters primarily based on the lowest proposed underwriting spread, without significant consideration of their experience or proposed services. D. Choose underwriters who have previously provided the municipal advisor with valuable referrals for other advisory business, believing this indicates a strong working partnership. Question 20. Quality control measures reveal that a municipal advisor in California is evaluating two potential refunding structures for a municipal issuer. Structure A offers a potential savings of $1.5 million over the life of the bonds, with a projected advisor fee of $150,000. Structure B offers a potential savings of $1.2 million over the life of the bonds, but carries a slightly lower risk profile and a projected advisor fee of $120,000. The municipal advisor is aware that Structure A, while offering higher potential savings, also has a higher sensitivity to interest rate increases, which could erode a significant portion of the projected savings. The advisor's compensation is directly tied to the amount of savings generated. Which approach best adheres to the municipal advisor's duties under Rule G42 in California? Option A. Recommend Structure B, as it has a lower risk profile and a lower advisor fee, without conducting a detailed quantitative analysis of Structure A's downside risk. Option B. Recommend Structure A, but only after conducting a detailed sensitivity analysis that quantifies the potential erosion of savings under various adverse interest rate scenarios, and presenting these findings, along with the net savings after considering risk, the issuer for their informed decision. Option C. Recommend Structure A, focusing solely on the headline savings figure of $1.5 million without performing any further analysis of interest rate sensitivity or risk. Option D. Recommend Structure A, emphasizing the higher potential savings to the issuer and the corresponding higher fee for the advisor, as this structure is more lucrative. The correct answer is B. Recommend Structure A, but only after conducting a detailed sensitivity analysis that quantifies the potential erosion of savings under various adverse interest rate scenarios, and presenting these findings, along with the net savings after considering risk, to the issuer for their informed decision. Explanation: this scenario presents a professional challenge because it requires a municipal advisor to balance their duty to the issuer with the need to avoid conflicts of interest, particularly when compensation structures could incentivize certain recommendations. The core of Rule G42 for non-solicitor municipal advisors in California is the obligation to act with the highest standard of care, which includes providing advice that is fair, impartial, and in the best interest of the issuer. This requires a thorough analysis of all relevant factors, not just those that might lead to a higher fee. The best professional approach involves a comprehensive financial analysis that quantifies the potential benefits and risks of each financing option, including the impact of different interest rate scenarios and the issuer's overall financial health. This approach directly aligns with the duty of care under Rule G42, which mandates that municipal advisors must have a reasonable basis for believing that their advice is suitable for the issuer. Specifically, it requires the advisor to consider the issuer's financial condition, needs, and objectives, calculating the present value of savings under various interest rate assumptions, as well as the potential downside risk of higher interest payments, provides a quantitative basis for recommending the option that offers the most favorable risk-adjusted outcome for the issuer, irrespective of the advisor's compensation structure. This demonstrates a commitment to the issuer's best interests above all else. An incorrect approach would be to solely focus on the option that yields the highest potential fee for the municipal advisor, even if it carries greater risk for the issuer. This fails to uphold the duty of care because it prioritizes the advisor's financial gain over the issuer's financial well-being. Rule G42 prohibits advisors from engaging in practices that could be seen as prioritizing their own interests. Another incorrect approach would be to recommend the option with the lowest upfront cost without a thorough analysis of long-term implications or potential future interest rate fluctuations. While seemingly beneficial in the short term, this neglects the advisor's obligation to consider the issuer's overall financial picture and future financial needs, which is a key component of the duty of care. The advisor must provide advice that is suitable in the long run, not just for immediate cost savings. Finally, an incorrect approach would be to recommend the option that is easiest to implement or understand without a rigorous quantitative assessment of its financial merits. Rule G42 requires a reasonable basis for advice, which necessitates more than just a superficial understanding or preference for simplicity. The advisor must demonstrate that the recommended course of action is financially sound and in the issuer's best interest through diligent analysis. Professionals should approach such situations by first identifying the issuer's objectives and constraints. Then, they must conduct a thorough, quantitative analysis of all viable options, considering both potential benefits and risks under various scenarios. The advisor's compensation should be transparently disclosed and structured in a way that does not create an incentive to provide suboptimal advice. The final recommendation must be supported by a clear, objective rationale that prioritizes the issuer's best interests.